Obviously, the economic numbers are terrible. We saw more unemployment today. The PMIs out of Europe are terrible, and we probably haven't seen the worst of it yet. At the same time, equity markets, while down, are not down as much as one might think. Are the equity markets right that are properly assessing what the government's willing to do to save the economy, or are they underestimating the risk?
Well, it's really good to be with you, David. So I think that we can definitely see that if we go back a little bit of a couple of months or so, the markets were in free fall. The markets were absolutely in free fall until the Fed came in with its program, not the rate cuts, that didn't help, but with the first round of alphabets of backing, and then the markets still were on the bottom until the fiscal authorities came in with their huge program. So it's no question that the equity markets are responding to the combination, the double-barreled Fed and monetary policy, on fiscal policy. On the other hand, it's also the case that when we look at where they bounced back to, we sort of say, okay, they bounced back to where they were in the middle of 2019, maybe not to the highs of the beginning of 2020. Middle of 2019, where do we think the economy is going to be in 12 months? Are they looking forward to that? Because if they're looking forward to that, they shouldn't be where they are now.
And Catherine, one very interesting point that you've made is this. Everybody talks about, is it a V, is it a W, is it an L, is it a U, things like that. Your point, I believe, is it depends on where you look, and specifically at what sector. It may be a different letter for different sectors.
Yeah. So a couple things. First, different letters for different sectors, and it's also different letters depending on what your time horizon is. So let's talk about the sectors first. Something like a manufacturing, much more like a V shape, because when the factory is shut down, you run down the inventories. When you have to ramp up production to make back up your inventories. Maybe not as much. We are tempering the V's a little bit because the supply chain continuity matters. Your factory may be open, but the next factory on the supply chain may be closed. So, you've got some tempering of the V shape in manufacturing through that relationship and the fact that the whole world is not opening up at the same time because the virus didn't arrive at the same time. The other set of sectors, though, for example, are ones where consumer choice matters. We call it getting back to play, meaning people are going out to entertainment, restaurants, sporting events, travel, tourism. Of course, people in those sectors they are the workers in those sectors. They're the employed people. But it matters whether or not there is consumer demand for those unstructured activities, things that you do by choice. Nobody's forcing you to go take a cruise. And so until that really gets back, those sectors, the workers associated with those sectors, and therefore the economy as a whole, is going to have a drag. It's going to be L-shaped for them. And so you get these very different shapes depending on the sector. You add it all up to an economy, and some of them are a little bit more V-shaped because there's a little bit more manufacturing, a little more tech maybe, and then other economies, that might be South Korea or Taiwan. And then there are other economies that are extremely tourism dependent. Those are facing L's, something like a Thailand, Singapore, or UK. These are economies very dependent on consumer choice sectors. The other perspective, though, that I think is important to remember is, depending on what is your time horizon as an investor, if you are very kind of a near-term, short-term time horizon, you're going to see these just amazingly collapsing economies on a quarter-to-quarter basis. So into the second quarter for advanced economies for most of the emerging world, except for Asia, which is being changed by China. Tremendous deterioration. But then huge rebounds in Q3, different for different parts of the world. So there's a lot of arbitrage in there from quarter to quarter. On the other hand, if you're kind of a long-term investor, you ask the question, when does the economy get back to the peak of economic activity as measured by, say, January 2020? How long does it take? probably takes 12 to 18 months. It means for the economy as a whole, things are bad until you get to 2021, midway through 2021. So what does that mean to you as a corporation if I told you your revenues weren't going to be back to their peak for 18 months? You know, that's a pretty tough thing to be thinking about if you're a corporation.
It is indeed, Catherine. One of the remarkable things, certainly I never thought I'd see it in my lifetime, we saw this week, was oil, with futures contracts actually trading well into the negative numbers. Was that specifically about some of the technicalities of trading in oil and having to take delivery, or was it indicating something more broad? And specifically, does it raise the specter of deflation?
Good set of questions there. So the negative numbers are a combination of technicality and real things, meaning where are you going to put it, where are you going to store it. If you can't find a place to store it and you've got a contract and you don't want to take delivery, then you're going to have to sell that contract, and that's how you get to negative numbers. But of course, underpinning this is oversupply, you know, the price war and a lot of supply being generated by both Saudi Arabia and Russia, as well as a lot of other producers. That supply is out there on the high seas and is going to arrive at ports in another month or so. So even when the production cutbacks that were agreed to get implemented, there's still an awful lot of supply out there. There's also this question about whether or not the production cutbacks are going to be sufficiently significant enough to offset, which is a collapse in demand for product. So it's a combination of the politics and policies about oil, price war and so forth, and the production associated with that, collapsing demand, and then the technicality of there's no place to put it, and I don't want to take delivery, so I got to sell. So that's the technicality of it. If anything, the oil markets probably are giving us a better read on prospects for the global economy, at least with regard to travel, tourism, and those factors that are important drivers of oil demand and other related product demand, whereas the equity markets are giving us a view of how policy is backstopping them, different degrees of backstop.
Right. Catherine, finally, we're going to hear from the central banks again, with the Fed, for example, next week, and a series of other central banks. We've heard an awful lot from them already. They've done an awful lot to support the economy. Is there more to come? And if we essentially lapsed over to monetization of debt as a practical matter?
Well, the Fed has made it very clear that they feel like they have as many instruments as they need, depending on the situation. My guess is that I think they knew that there was going to be this degree of fallout associated with when you close down the services sector of your economy, and services, account for 70% of consumption, production, and employment. Not all services, shut down. Of course, yours didn't, and mine didn't, because here we are. But a good portion of the economy did. So they knew that was going to happen, and they didn't want to have the financial fallout associated with that real side fallout to precipitate and create a downward spiral associated with, a GFC 2.0. So they know the degree of the challenge. They still have a lot of opportunities to get involved in the various markets, the financial markets, bond markets, through basically everybody. You could call it a policy put on the entire portfolio, but that's exactly what had to happen in the near term. So they have what they need to do going forward. Whether they're going to come up with more programs, I doubt it at this point. I think they've got enough programs. They need to do the implementation.